Hey everybody, my name is Matthew Sambanis. I'm a certified public accountant. My firm is based in Long Island, New York, and in today's video we are going to discuss the events of this past week. In particular, Nike sales absolutely crushing. We're also going to touch on Walgreens, and we're also going to touch on General Mills, which is a huge cereal brand, and they're all basically saying, you know, the consumer is not spending the money that they used to spend, and probably because the consumer doesn't have free money being handed out to them from the government, which is in turn their money and other people's money. And the consumer is probably not spending what they normally spend because the economy is broken, right? Interest rates are at very high rates. People can't tap out their home equity line of credits because most people have 2, 3, 4% interest rates. So they're not going to go refinance their house and get a 7, 8, 9% interest rate. And, credit card debt's at an all-time high. So the list goes on and on. Anyway, without further ado, let's get into it. Nike sales crashed Friday, which was yesterday, June 28th, 2024. It was actually down 20%, which is its biggest down day in history, right? I mean, that's a huge drop, and the ramifications, that to me is like, a red flag going up. What else happened this past week? Walgreens shares crashed. They were down 20%, and this is the lowest stock price that they've had in 27 years. And, it's because customers aren't spending the money like they used to. And what else? General Mills, who makes Cheerios, Lucky Charms, Yoplait, Blue Buffalo dog food, Betty Crocker, Nature Valley, Pillsbury, etc., their sales are down as well. These three companies, to me, represent the real economy, the real backbone of America, for that matter, right? I mean, you have healthcare factored in, you have consumerism factored in, and you have food factored in. And so, what corporate America is saying from these three companies is the foundation of the economy. There's cracks in it. And, I'd also like to point out that while the Federal Reserve is trying to, quote, fight inflation, the money supply actually shot up this month to $93.2 billion, which is a 4% increase, right? I'm sorry, a 0.4% increase, which if you annualize that is more than 5%. And again, if your intent is to have inflation average 2%, then why are you going to print more than 5%? And, inflation is the printing of the money supply. And, other signs that the economy is weak, and we'll also dive into Nike, by the way. I didn't forget. I apologize, or I thank you for watching this far. New home sales fell to 619,000. They were expecting 650,000. Core capital goods, they were looking for 0.1%. They got negative 0.6%. So literally a 500% decrease in the wrong direction. Q1 GDP had a revision. They didn't revise the numbers down, and it was a very weak Q1 GDP, by the way, especially when you compare it to quarter 4 of 2023. But basically, the personal consumption of GDP went down from 2.0 to 1.5, which also signals a weak consumer, meaning personal consumption went down. 67% of our economy is based on consumerism, and therefore the economy is weak. And what else happened before we get into Nike? The May trade deficit, merchandise goods deficit soared over $105 billion, which is over the highest in over 2 years. And that's with a decline in imports and exports, right? So if you're not making as much as you used to, then, that shows, hey, you probably have a weak economy. And if you're not importing as much as you used to, that shows, hey, I'm not making as much money as I used to. And that also shows a weak economy. So, basically, long story short is the government's broke. The government's operating at a deficit. Ultimately, we will recover from this. But the consumer is broke. Credit card debt's at all-time high. Loans are at all-time highs. The list goes on and on. But we're not on a sustainable path at this point. So let's get into Nike. Nike's revenue fell 1.7% year over year, $12.61 billion, well below the $12.86 billion. And, that to me, listen, that's not too bad to me, right? I mean, that's not the end of the world. They're still pulling in a ton of money, but the shocker comes down the road in a little bit. And another thing to point out, direct revenue via the company's website, app, and stores decreased 7.3% year over year, well below the estimate of $5.68 billion. So if they had a 1.7% decrease overall, or let's call it 2%, but on their website it was a 7.3 decline, why is that? Well, they're still selling from their wholesale goods and retail, but not directly. And I also printed out some stuff from their website, so we'll go through that next. But anyway, Bloomberg intelligence analyst Poonam Goyal said the underperformance at Nike's own sales channels come by surprise and is reason for concern, as the active wear giant could be turning its core shoppers away due to lack of newness. So I went to Nike's website. I printed out 17 pages of their product, and it's not newness. It's prices. And it's a broke consumer, and a consumer who's not getting free money anymore, and a consumer who's tapped out and can't get any more credit card debt and can't get a home equity line of credit. Their first shoes, Nike Pegasus 41, $140. If it printed out in color, I would show it to you, but these things are atrocious looking. Not only are they atrocious, $140, I spend $70 on my Merrells on Amazon, and I'm happy to spend that, and I buy them in bulk. And if I could buy them for cheaper, I would buy them for cheaper. What else do they have? Bestseller, Nike Challenger men's dry fit 5-inch brief-lined running shorts. 7 colors. $40 for a pair of shorts. I don't know. Shorts to me should be $15, $20. Maybe I'm used to shopping at Marshall's and TJ Maxx and Home Goods. Not that you buy clothes at Home Goods, but I try to shop as cheap as possible because I want to spend as little money as possible. What else? A t-shirt, $35. And this is a plain Jane t-shirt with a Nike logo and a flame in the middle. And then we move along. Nike Vaporfly 3 men's road racing shoes, $260, right? Like, no matter how much money I've had or have or don't have, I would never spend $260 on a pair of shoes. I mean, that's psychotic to me. I own On Holdings, the stock. I bought, it's one of my biggest positions in my portfolio. It's a sizable portfolio, depending on who you're asking. To some people, I'm sure it's chump change. To other people, it's a lot of money. I want to buy a pair of On Holdings, except I can't justify spending $140. Now, the only reason I would be able to is to see what's so great about it. But that to me, again, I see the numbers. I see how they're moving. Why do people spend so much money on this stuff? That's the problem. And ultimately, prices have to come down. Or, in this instance, Nike will continue to sell wholesale and people will continue to buy at discounted prices. Anyway, the biggest product line footwear, and most notably Chuck Taylor brand Converse, saw revenues plunge. So Converse was actually down 20%. I mean this with all due respect. Converse, they're ugly shoes. I don't know why anybody would buy them. I've never had a desire to buy Converse shoes before. I probably never will, unless they completely revamp them and make them really, really great. But yeah, Converse is a hideous brand. And those they really aren't making new. So that's where the biggest plunge was to Nike's defense. And here's the whopper that I was talking about before. During the earnings call, Nike management said that it sees 1Q revenue down about 10%, dramatically worse than the 3% decline consensus had expected. So, they're saying their revenues are going to be down 10%. That's huge when you're talking to a company that's doing 50, 60, 70 billion dollars a year in sales. And what's the end result of that? Well, people are going to have to take it on the chin. Nike Chief Executive Officer John Donahoe is cutting $2 billion in costs and slashing 2% of the workforce, with layoffs recently hitting the company's European headquarters near Amsterdam and its Boston-based Converse brand. Okay, well, you got to cut Converse because that's obviously losing you money. And, to touch on General Mills, which just drives the point home, their shares plunged 8%. And, they said due to a larger macroeconomic landscape, a more challenging operating environment. It's definitely a more challenging operating environment. Everything costs way more than it should, and brands aren't lowering their prices. And until they lower their prices and stop, I don't want to say ripping people off, but we both know, if you can charge the most, you should charge the most, and that's fair, and that's capitalism. But when you have to lower prices, you have to lower prices, and that's what these companies are going to learn. The consumer can only spend so much. So anyway, please like, comment, and subscribe. I did a video yesterday touching on Walgreens. I'll probably do a separate video touching on General Mills. But again, same thing. Walgreens blamed the worsening outlook for the year-on-year, worse than expected consumer environment driving higher promotional activity, negatively impacting the retail margin. Yeah, they have to cut their prices because consumers are tapped out. And, when you look at the inflation reports or you look at retail sales, it doesn't account for inflation. And if it accounted for inflation, you would see that people are buying, yes, they're spending more, but they're getting a lot less. So anyway, what's the solution here? A, earn more money. B, save money. C, cut your expenses. Invest in things that are going to make you money. Put your money to work for you. Don't risk it. Don't gamble it. Make sure they're sound investments that you feel confident and comfortable in. Do the next right thing from a humanity standpoint, which has nothing to do with nothing, just me philosophizing. And again, if you found this informative or helpful and you watched this far, then thank you very much. And please be sure to like, comment, and subscribe. Okay, have a great weekend.